Good morning, everyone. Very welcome to this symposium on market fragmentation. Thank you, everyone, for coming. Especially special thanks to the speakers who have flown in to come here to teach us about market structure today. This is a joint event between Stockholm Business School, where I'm a professor, and Svensk Värdepappersmarknad, Swedish Securities Markets Association. So I'm working with Erik Einert in setting up this event. Why market fragmentation? I think market fragmentation is probably the single most influential feature that we have witnessed in the last 15 years or so. So 15 years ago, European stocks may have been fragmented through a dual listing. There was some OTC trading, but a lot has happened since then. We have seen MiFID I and MiFID II, the arrival of competition in the lit market, so we don't have the national champions in the exchanges. There's lots of competition there. Then we got dark pools and systematic internalizers. So we now have a very diverse trading environment where it becomes really relevant, I think, to think about is more competition now what we need? So competition is good for finding niches for all the different traders and maybe to push down the costs. But on the other hand, with hundreds of trading venues, we get a lot of complexity, and it's really hard to, could be really hard to understand the markets these days. So it has really changed. So I don't know if you know what is the largest trading venue in Europe these days. It's not Nasdaq, and it's not Euronext, and it's not LSE, it's CBOE, BATS Chi-X, who offers trading in all European stocks. So that's a huge change. That's an exchange without any listings on their own. And you know what the second largest trading venue in Europe is? That is Goldman Sachs, systematic internalizer. So LSE is only the third one on that ranking by volume. They, of course, don't have any listings either. So let me show you an example, a snapshot for what market fragmentation looks like in Sweden at the moment. I took one stock, a Swedish Match, and looked at the data from last week. And I excluded the off-market, the OTC trade here. And then the traditional exchanges have around 50% of the trading volume. And that is not only Nasdaq, it's the other lit venues too, including CBOE. And then they have another part of the pie there in the opening and closing call auctions that has become really big. And then we have dark pools and periodic auctions and systematic internalizers. And all these types of trading venues is what we will hear a lot about in the first session this morning. So I think it's a good week to have this discussion about market structure. Given that you're here, I think you don't have missed that there was a flash crash in Stockholm the other day. This is what it looked like for Swedish Match, which was not one of the hardest hit stocks, but I think the pattern is very typical. You can see a big volume spike at just before 10 a.m. and a big dip in the price that then just reverses within 10 minutes or so. So this, I think, is great motivation for market structure discussion. And I think it is relevant with market fragmentation here as well. So I looked at the data the Monday before. Then the pie chart looked like this, with 71% in the exchange. If I took the morning hours from 9:55 until 12. So what do you think happens during a time of uncertainty like we had on Monday? Well, the exchanges, it changes quite dramatically, even for this stock that was not at the core of the event. So the exchanges took 82% instead. The black part there, that's the dark pools, and the dark blue is the periodic auctions. So they seem to lose market share, whereas the systematic internalizers are boosted in such times. So that's, I think, was interesting to see what is going on during such uncertainty. That was just a brief introduction. So me and Eric, we have invited 4 papers to listen to this morning. The first session will be about the dark pools and systematic internalizers under MiFID II. So we have Peter O'Neill from the FCA in London, and then we have Fatemeh Aramian from Stockholm Business School. And then we have the second session that will be about the effects of market fragmentation and the effects and the merit of having continuous trading in the markets, where we have Benjamin Clapham from Goethe University and Roberto Pascual from all the way from Mallorca, Universidad de las Islas Baleares. And the plan is that for each paper we have around 40 minutes. So the author will get 20 minutes for a more or less uninterrupted presentation of the paper. And then each paper has a discussant that we have, and here we have turned to the industry to give comments and give their, so that we get the industry perspective in as well. There we will also open up for Q&A from the audience. So I really encourage you to chime in and ask your questions. So with that, Peter, I leave the floor to you. Very, very, very welcome. We look forward to your presentation.
So thanks, Bjorn, and thanks, Eric, and the organizers for having me. So this is joint work with Christian, Ari, Peter, and Felix. You might be wondering why there's such a diverse group there. Well, 2 of those people used to work at the FCA, but they've moved on to the IMF and a consulting firm in Germany. But Ari is still at Warwick, and Peter is still at the ECB.
There's a clicker for you.
So the paper is titled Banning Dark Pools, Venue Selection and Investor Trading Costs. So the motivation for this work is that much research in academia is focused on the impact of dark pools on lit markets. But it hasn't focused much on how institutional investors in particular benefit from and use dark pools. This has mostly been a result of a data limitation with academics, where they don't really have access to parent order information, so it's difficult for them to look at the implementation shortfall of parent order trades. So this exposes a tension between protecting the lit market versus an investor benefit from dark pools. And this kind of exposes the negative externalities which are claimed from dark pool trading versus the private benefits that investors receive from trading in them. So in this paper, we examined the impact of dark trading on investor execution costs, which we measure as implementation shortfall. And we look at the venue selection of individual investors and their routing logic. So which venues they choose and the sequence by which they choose those venues. And we also look at the ban on dark pool trading that occurred when MiFID II was introduced in 2018 because of the double volume cap, which I'll explain later. So here's the current state of regulatory divergence. So here's the current state of play, which has shifted a bit since this paper examined the 2018 ban. So since then, the UK has suspended this double volume cap regime, which bans dark pool trading when it exceeds 8% of total trading in a given stock. And it will legislate to remove this ban entirely. On the EU, by contrast, has proposed to replace the double volume cap with a single cap of 7%. So the secondary cap, 4%, applies to individual trading venues, whereas the 8% cap used to apply to all trading venues in a given stock. So they've decided that the 4% isn't adding much to this, which I think everyone would agree with, and they're replacing that with a 7% cap. Why 7% and not 8%? Well, they explained that the reduction by 1% compensates for the loss of restriction of the 4%, which seems arbitrary, but then again, the 8% originally was considered arbitrary when it was first introduced. They're also moving to push periodic auctions to have more pre-trade transparency. So the periodic auctions were considered to be somewhat of a loophole, if you will, to get around the caps by using a waiver which wasn't subject to the caps. So they're combating that by saying, well, let's make the dark, essentially almost dark trading, more transparent, more lit. So already there's an indicative uncrossing price and volume in these periodic auctions, but they're pushing for an auction kind of order book to be visible, but they haven't sort of specified exactly what they want. And lots of commentators have pushed back on that. And they're also saying that midpoint trades won't be allowed for across all venues when the trade size isn't sufficiently large. And they use this standard market size threshold, which is 10 to 30K. Okay, so the paper examines whether or not dark trading has an impact on transaction costs. And the academic theory is that dark pool trading should actually lower lit market liquidity. And the empirical analysis hasn't necessarily borne this out. Some papers have found that it's lowered transaction costs for individual trades, but others have found that it hasn't had any impact on the lit market, and by virtue, the transaction costs. Other papers have found that there's actually a negative impact of dark pool trading, but only in the context of large amounts of dark pool trading. So the first hypothesis we're going to look at in this paper is, does dark trading lead to lower investor transaction costs? And we'll also look at whether or not the substitute venues, which were the periodic batch auctions, were used to kind of circumvent the ban through participation externalities. And then finally, we're going to look at whether or not the dark pool ban as a whole increases investor trading costs. And this is a question of whether or not the participation externalities of the periodic auctions dominate the reduction in the ability to trade in the dark pool. And we're also going to look at whether or not the venue choice follows a pecking order. So whether or not the use of dark pool trading reduces over the life cycle of a dark order. And whether or not we also see a more pronounced decline on high volatility days and for more informed investors or more impatient ones. Because dark pools, as we know, are not the quickest execution venue. So we find that dark trading is associated with a reduction in transaction costs for individual investors. So we're actually the first, we believe, academic paper to show this on an institutional parent order basis. And we do find that liquidity shifts to periodic auctions when the ban occurs. And this means that there's no impact on transaction costs for investors of the dark pool ban in 2018. We also find that investors do follow a pecking order. So dark venues are executed first, and this usage declines over the course of the parent order. And there's a more pronounced decline for impatient orders or traders, but not for high volatility days and more informed participants. Okay, so we use the FCA's transaction data, which is the data set which we obtain by MiFID II regulatory reporting, which is every trade in UK stocks by every participant in Europe, and where they trade, and essentially who they trade with, and how they trade. It contains legal entity identifiers, so we can identify individual investors and then look at their transaction costs. And so we string together their trades into parent orders, so we can look at how the implementation shortfall is impacted by the use of dark venues. And we calculate this in a very conventional way, which is the signed difference between the price at the beginning of the order and the VWAP. And the sample period we look at is the 20 days around the ban in 2018, which occurred in March, and its subsequent lifting. So we have two events in this sample. So here's a quick primer on European execution venue types, and you're going to see a lot of discussion around these in the rest of the talks today. So the actual venue which was subject to the ban was midpoint dark venues, which you can see there in bold. And those are, for example, Chi-X dark, turquoise dark, or UBS's MTF. But there's these new venue types, periodic auctions, which are auctions that occur several times a second. And participants can submit a lit market midpoint order. So a midpoint order which references the lit market midpoint. And there's also other venues there. So systematic internalizers will be covered in the next talk. These are bilateral executions with an SI operator. And also the traditional block venues are also another venue. So we examine the choice of these venues by lit market, by participants, and how that affects their execution quality. So the first result I discussed shows that the use of dark pools reduces transaction costs. And this is something that might seem obvious to industry observers. You know, they're big fans of dark pools. They've been using them for decades. You know, this finding might seem very, very obvious and uncontroversial. But for academics who have been studying this, it's not as obvious because of the impact on lit markets. And for regulators, it's not as obvious because they've gone ahead and banned these things, you know, a few years ago. So I think it's important for this finding to kind of be established, and we do it in a way which we think is very compelling. So we regress individual parent orders for individual participants. We control for stock and date fixed effects and participant fixed effects. So that means we're controlling for any individual stock or date information which could be driving that parent order. We also control for the parent order size and the time it takes to execute a parent order. Obviously, if you take longer to execute a parent order, the implementation shortfall will be larger. So we control for that. So once we do that, we see that a 10% increase in midpoint dark trading is associated with a reduction of 1 basis point on implementation shortfall. And we think this is economically significant because the mean implementation shortfall in our sample is about 12 basis points. And as you can see there, it's even larger for block executions, as you would expect. And once the ban occurs, which is in the second column, periodic auctions become significant during the sample. And then we see a reduction there, which is sort of on par with midpoint dark venues. And then we also see, obviously, the size of the parent order being important in impacting implementation shortfall. Okay, so when we see the ban occur, we want to look at what investors do. How do they change their routing decisions? So what we do is we identify dark participants as participants that execute in dark pools more than others in the sample. So we take participants which, in the cross-section, execute more than the median in dark pools. And then we interact them with the ban event. So we're seeing how the ban event impacts their submission strategies. And we're regressing the venue shares, which is the percentage of that parent order, which is executed in each venue in this regression. So when we see the increase in periodic auctions there, that means that they're substituting their flow into periodic auctions. But they're also doing it to lit markets, which will obviously make the European regulators happy, because that was the intent of the ban, was to kind of reduce dark trading. So when the ban is lifted, so for stocks that were banned, they're only banned for 6 months. So when that ban is lifted 6 months later, we see an inverse effect. So we see the flow go back to sort of unwind. We see the negatives there at the bottom. Okay, but what about overall institutional investor trading costs? So we would hope that the whole point of banning these dark pools was to improve the markets more generally. So, you know, institutional investors are an important part of markets. They're often arguably the most important participant in markets. And, you know, in this study, we're able to actually directly measure these institutional investors' transaction costs. So when we regress their implementation shortfall for individual parent orders, do we see an effect from the ban or the lift? No, we don't. And, you know, this is perhaps unsurprising, because in the previous analysis we see that they've substituted to these venues which we know reduce their implementation shortfall. So they've managed to kind of mitigate the potential negative effects of the ban by substituting their trading into periodic auctions. So we see no impact. Okay, now I'm going to look at examining how investors trade, and the people in the audience will be able to kind of comment on this in the Q&A to sort of add some additional color, hopefully. So what we do here is we decompose for an individual parent order, for each quantile, the percentage of executions that are done in each venue. So the first quantile is the first 20% of the order in terms of the sequence. So as we would expect, we see block dark pool executions heavily represented there, about 22%. We see that trail off as the parent order depletes over its life cycle. And the average life cycle of a parent order is about 4 hours in our sample. We also see midpoint dark venues reduce over the course of the life cycle. And then obviously in the last portion, we see auctions heavily represented. So we examine the same effects with a regression, which is regressing a dummy variable of 1 for individual child executions in a parent order in the respective venues there in the columns. And we essentially just demonstrate the same thing, but in a kind of more robust empirical way. And then what we want to do is we want to examine the impact of external factors or investor characteristics on the decision to trade in various different venues. So on high volatility days, do we see a more pronounced decline in in this use of dark venues. But we do not see that in this table. And we also measure whether or not the investor is informed by looking at the whether or not an individual investor's trades are predictive of price changes. So we regress the order flow informedness to identify informed investors, but we don't see any impact of informed investors on their choice of venues. We do also measure impatient investors. So for an investor whose trades are more than the median in terms of the percentage aggressiveness of their orders, that has an impact on the use of dark venues. So they're more likely to switch to lit venues if they're more aggressive on average. Okay, so to conclude, an increase in dark trading is associated with a reduction in investor trading costs, which we measure as implementation shortfall. And this is the most complete measure of trading costs that we have. Other studies look at the impact of individual orders, but if we've got many child orders in a parent order, that provides an incomplete picture of trading costs. We see participation externalities in the form of periodic auctions arising to substitute for midpoint or venues in the sample. And we see the DVC ban on dark trading did not impact trading costs as a result. And we also see the usage of dark pool trades decreasing over the parent order life cycle, consistent with a pecking order theory. And this is more pronounced for investor impatience. Okay. Thanks for your time.
Thank you, Peter. The discussant is Fatemeh from SEB.
Can you hear me? Yeah, good. I'm Fatemeh from SEB. Hello, can you hear me? Okay, good. I'm Fatemeh from SEB. I'm product manager for equities, and I work with a lot with regulation, market structure, and with technology. My background is I started at Exchange many years ago. I was responsible for systems development many years. And I started at SEB 2002. And as Björn said, the big changes came 2007, where we got MiFID, where we started to get fragmentation on one hand and competition on the other hand. So we got innovation. And the first time I encountered dark pools was in 2010, where we started to look into that. I also had the algorithmic trading department at SEB by that time. So we started to look into dark pools, and by that time, dark pools was not regulated at all. When we moving into MiFID II, there was a lot of debate on dark pools. First of all, the dark pools in MiFID I was not regulated. Secondly, you can trade on any price. You can trade on bid, offer. And the third one, it was totally unrestricted in terms of volume. So when we sat down in Swedish Securities Markets Association, discussed MiFID papers, actually double volume caps was on the top priority, because that was discussed a lot in Europe, and there was divided between the Nordic, Dutch, and UK. They were opposing the cap, whilst Spain and France and Italy was pro getting this double volume cap. Eventually we got the cap going. We were very concerned about the cap, and so were our clients. But again, innovation, as Peter said, we got the periodic auctions. So actually the effects of the ban of the double volume caps was quite limited. So we trade a lot with periodic auction today. And when we go to clients, I think our abilities to trade in the dark is really key. I think that's one of the most important tools we have to trade in the dark. So we spend a lot of time on doing algos and so forth just for the purpose of trading dark. And we also have heavily debates whether dark pools is good or bad for market liquidity in the lit market. I would actually say that many of the clients would never send an order into the market if they cannot do it dark. So I don't think it's a zero-sum game. Either you trade dark or lit. I think that a lot of the volume that's going into the dark today is going there because it can be dark. Otherwise, they keep the order for themselves. So now, as also Peter said, we're moving into a review of MiFID II, where the regulators and others are looking into changing the rules again for dark pools. And one of the changes are that you cannot trade dark unless it's over a certain threshold. And I would say that that's very negative for the market, because I would say 60-70% of the volume today are below that threshold. So that this new rule will actually kill the dark pools as we know it, because dark pools is extremely important for when we're trading an order over the day. We have like, for example, the volume weighted average price as benchmark. Being able to trade in the mid dark throughout the day, it's in very small chunks is crucial. So I think the new rules are actually in Europe will actually, I would say, the risk of making the situation worse for the investor. That was a long introduction, but one question that I have to Pete was about the double volume caps. You were discussing there's a substitution between periodic auction and dark pools, which I concur with that view. Wouldn't it be so that the regulators could leave to the market to find the right balance between periodic auctions and dark pools and just skip the double volume cap, as they planning to do in the UK?
I guess, yeah, so that would be the UK's approach. Yeah. I guess in the European proposals, they're not leaving that open. So they're sort of changing the nature of periodic batch auctions to be more transparent. So that sort of equilibrium can't really occur. So they're sort of not. So even in the context of the additional restrictions that they're proposing, they're also changing the nature of this new venue type, which is quite popular. So.
And I think that the changes that they're doing on the periodic auction is perhaps even more damaging. So I think what we don't understand, when we look at the UK, for example, when we look at different opinions or standpoints, I think we often look at the FCA because they are really on the forefront. So that's why we don't understand why Europe and UK, the smart people in both teams, so to say, and they have so different view on how the market should be structured, and the end goal should be to lower the cost for the investor. So that's what we are not understood yet.
Yeah, I can't explain that, unfortunately. Yeah. I don't want to get in trouble by sort of saying anything too controversial.
Yeah. but also, if you took as an example of, you talked about the pecking order. That's exactly how we work. We usually, depending on what benchmark the client has, usually start with midpoint, dark. And if we don't get a hit there, we move on to the periodics or to the lit markets. And let's say that they will introduce a threshold that you cannot trade the dark unless you are 30,000 euros. That will definitely change the pecking order. And that means that if you have like an order where you split during the day with an algo, with very small chunks, the pecking order will change, because if the order is below this threshold, you either need to keep the order for yourself and not send it. You have an alternative cost, obviously, or you have to pay the spread. So, what would you think that all those nitty-gritty thresholds could actually harm the outcome of the execution, instead of just leaving it to the market that to find the right balance of different venue types and different goals?
Yeah, I mean, you made an interesting comment when you said that you like the design of a periodic auction. So that implies that you're using periodic auctions even when the ban isn't in force.
Yeah, definitely.
Right? So you find it more preferable to even midpoint dark venues.
Yeah, because that has been a change the last years, actually, because you have the dark pools versus the periodic, and different characteristics, obviously. On the dark pool, you have totally black. Yep. Periodic, you have slightly. In the periodic, you have a kind of speed bump. You don't have the immediacy. So there is a trade-off there, but we started to use periodic quite a lot. I think we probably have the largest market share in periodics and Stockholm exchange. But we have seen lately, actually, with this automation and algos, that when we started to use periodic auctions a couple of years ago, you send an order to a periodic, and suddenly you see that there is an equilibrium price. So you have someone on the other side, and then your trade. Yep. But what we are seeing now is actually that when we send an order to a periodic and we get a hit and the equilibrium price, new quantities coming in. So I think that's a very interesting development on periodic. I think this will strengthen the view that periodics will. I think the periodic will increase in market share, regardless, because I think the price discovery is one thing, but also volume discovery is interesting. So I think that what we have seen is that periodic is becoming even more interesting.
Yeah, so it's interesting that you derive a lot of value from this venue, but so the original intention, I think, of the cap, the double volume cap, was to ensure that dark trading wasn't too large, which would impact lit market venues. But you know, even in small amounts of dark trading, you know, let's say 3 or 4%, you're deriving a lot of benefit from these venues. So it seems that the new restrictions that are being proposed would limit that benefit, even in small amounts, which seems counter to the original kind of intention. So.
Yeah, I totally agree. And when we talk about the price discovery, the risk that too much dark pool will have negative effect on the price discovery. I think one thing that we haven't discussed so much is actually the tick size. I think Eric and I have discussed that a lot, and instead of curbing the dark pool trading in order to get more liquidity in the order book, I think they should actually again revisit the tick size regime, because I think the new tick size regime that was mandated in MiFID II was slashing the tick size in the Nordic market. We usually have quite a large tick size and big volume on the sides. And obviously this is a trade-off in tick size, because if you increase the tick size, you will get more volume in the book, but you will get bigger spreads, and bigger spreads will mean that the demand for midpoint matching is increasing. So that will drive more to the dark pools. But on the other hand, you will have sufficiently liquidity on the buy bid and offer to have the correct price discovery.
Yeah.
So Eric and his team have been mandating a lot to actually revisit the tick size. I think that's a forgotten item that affects a lot of dark pool trading and periodic auction stuff like that.
Yeah, no, I mean, and the proposal to prevent midpoint executions, you know, is again sort of bringing up tick sizes and merging it with the dark pool kind of discussion. Yeah.
Thank you both. Let's see if there are any questions from the floor, from the audience. I have one here.
Thank you for a very interesting discussion and presentation. So I have a question on the Peter's regressions in the paper and the implementation shortfall measure. Have you tried to decompose implementation shortfall into looking at the spread cost alone and the price impact part? Because that would be interesting. It's kind of the same as the pecking order thing you're doing, yeah. But it's, to me, that seems to be a detour, and that would translate more into the public debate by doing that directly.
Yeah, so it's something we had considered doing, and it's an interesting question because you're essentially asking, do investors benefit from the midpoint spread saving component of trading in dark pools?
Yeah.
Or do they benefit more from the information hiding component via the price impact? And that's something that we essentially were pushed away from doing by the sort of the academic reviewers who wanted us to do more the sort of pecking order stuff, which I guess maybe is more interesting to an academic audience, but perhaps less interesting to an investor audience. But we could work on that regardless.
Yeah, because, or do you get different result for the diff-in-diff regression pre-post? Well, not different, but which of the two, for which of the two components will you get the significant positive, negative coefficient? That would be interesting to see.
Yeah. Yeah, no, it's something we should look into.
May I grab it? Thank you. You talked a lot about the pecking order here, both Kisto and you, Peter. And it's also ties together with the patience of an investor, right? So wouldn't first best be to be having limit orders at a lit market when you can earn the spread? Especially when the tick size is wide. I mean, wouldn't that be the first? And this is here you just downgrade the lit markets, both the practitioner and the academic downgrade the lit markets to second order. So I wonder why.
I would say for limit orders in the lit book, I think it's damned if you do, damned if you don't, and if you place an order in the book, you are exposing yourself to volatility. And if you have a liquidity event, that someone is actually hitting you in the market, you will be executed. No, your order will be executed. Hopefully not you.
It's not that dangerous.
Yeah. That might be good, but that could also be in informational events, and in that case, you're smoked. That's not a good way to have the order in the lit book, because then the market you will be traded through, and there will be a new price, much lower. And if you have an informational event on the other side, you will miss out on the other on the ask side. So it's a quite tricky balance when to post an order in the lit order book. So in the best of worlds, you can place orders in the book, and you only get liquidity events against you, but you also have informed flow against you.
But the spread compensates you to some of those concerns, right? That's the idea, at least. So if it doesn't, then there is something wrong with the construction of the limit order book in the first place.
Yeah, and
if you don't want to submit liquidity, then it's a problem, right?
Yeah, but then you're coming back to the tick size. If you have very small tick size today, you have that risk that you don't get paid too much to have too much liquidity in the order book, because the price of crossing the spread or going to a dark book is very low. So that, again, that's why I think that one of the things that the market should do is actually to widen the tick size, and then you will get more volume on the sides, even if the spread is a little bit bigger. But then you can use periodic auction and dark pools without the downside of the liquidity in the lit book is too small. But it is a tricky question. So there's no simple answer.
So unfortunately, we don't have access to orders in the study, so we can't look at that. But it's obviously as a so we use that using the trades. So we proxy for that by sort of looking at where the trade occurs. But yeah, I mean.
Okay, one final question from me. You touched upon that the reason why they're trying to restrict dark pools and SIs and everything is the exchange arguing that if the market share becomes too high in the dark, it will hamper the lit market and the price discovery and things like that. Have you seen any evidence in your samples that shares with a higher market share in dark pools has less benefits from trading at mid? The 1 basis point you mentioned, that shares with a higher market share has a less benefit than those with a lower market share in the dark pools?
So we don't look at that in this study. We try to focus on making a compelling argument for dark pools by demonstrating their benefits to institutional investors. Other studies have looked at what a large amounts of dark pool trading do to lit markets, and those studies are here. And as you can see, a lot of them don't find a large impact, but this is still an active literature. So some of the authors here are actually in the audience, so you can get some more information from them. But in terms of our study, we don't find an impact which is interesting, because as you can see from here, some of the flow does go to the lit market. So if we were to sort of buy into that story, we should see an improvement in lit market liquidity. And then if that's the case, we should see a reduction in trading costs, which we don't see. So That's one piece of evidence that we have.
Thanks.
All right. Thank you.
Thank you very much. We are moving on to the second paper by Fatemeh Aramian and Lars Nordén, who are both at Stockholm Business School. Yeah.
Okay, hello everyone, and thanks to the organizers for having the paper in the program here. The paper I'm going to present today is about high-frequency traders that operate as a systematic internalizers, which we call it here in this paper, single dealer platforms in equity markets. We know that MiFID II regulation promoted systematic internalizers as a qualified execution platforms for market participants. As a result, the number of SIs increased significantly in equity trading, for example, from 13 in 2017 to 73 platforms in 2019, and also subsequently the market share increased from 2% to almost 20%. And this sharp growth in size made the European equity markets even more fragmented than before, based according to ESMA, European Securities and Market Authority, and raised concerns on the possible adverse impact they might have on the market. High-frequency traders were also among the trading firms that were motivated to operate as SIs. And some of the HFTs that were mainly active in the multilateral trading-based venues in Europe experienced a significant increase in their activities in bilateral settings of exchanges as HFT-SIs emerged in 2018. From academic literature, we know that HFTs, overall, their activities improve market quality. And here in this research, motivated by the important role that HFTs have in the market, especially with respect to market making, we aim to examine the effects of trading on HFT-SI platforms on market quality, and the association they have with HFT's liquidity provision on public exchanges, and also how they are related to HFT's inventories. To summarize the main finding here, what we find here is that the trading activity on HFT-SIs is detrimental to liquidity on exchanges. Basically, depth decreases, quoted spread increases significantly, while the effective spread remains virtually unchanged. Basically, the changes are not very economically significant on the trading cost. The natural question that here can arise is that what is the possible channel for the observed market quality? And this is where we examine the association between the trading on HFT-SIs and the liquidity provision of corresponding HFT on the public venues. And we find that an increase on the trading volume of on HFT-SIs is associated with a reduction in the liquidity supply of the corresponding HFT on the exchange. And later in the presentation, I will explain more in detail what are the possible reasons for that. And finally, when it comes to the inventory management, we use a couple of inventory measures as a proxies for HFT's inventory behaviors. And what we find here is that an increase in the trading activity of HFT-SIs is associated with overall improve in the overall inventory management of them. Before here going to the empirical setting, I will have a brief overview on the institutional details of SIs. They have some regulatory restrictions, as obligations, as you know, and also some flexibilities. They have to publish two-way codes continuously during the continuous trading sessions of the relevant exchange, but this is only for the liquid stocks and also for orders that are up to the standard market size, which is usually 10,000 euros for most of the European stocks. While the pre-trade transparency is waived for illiquid stocks and also for orders that are above the standard market size. They also have the obligation to make the trades information public, similar to exchanges, as close to real time as technically possible. And when it comes to the tick size, they have to follow the harmonized MiFID II harmonized tick size regime for orders up to the large in a scale threshold, which is determined based on the average daily turnover of each stocks. They also have a flexibility, according to the regulation, to refuse entering transaction with certain counterparties or client based on their risk evaluation, like a counterparty risk or different kind of risk that they evaluate, which can help them to have a better control over, for example, adverse selection risk by avoiding the interactions with some traders, like informed traders. For this research, we focus on the Swedish market, Swedish stock markets, basically 45 large cap Swedish stocks, and the sample period will be the whole year of 2018. And the reason that we focus on the Swedish market is that we have access to the TRS transaction reporting system data that provide us with trades by distinct trading firms on all trading venues. And also we see trade executed by each individual SIs that helps us to differentiate between HFT and non-HFT SIs. And also we have tick-by-tick trade and code data from the definitive tick history. And the trading venues are, of course, the SIs and also all main exchanges, which is Nasdaq Stockholm, the traditional one, and the main 4 MTFs that we have in Europe. What we see here in the data that we have, that HFT SIs capture 23% of the total trading volume executed on SI platforms, while the main market share goes also to the non-HFT SIs, which captures 76%, almost 77% of the trading volume executed on SIs. For the market quality, as I mentioned, we focus more on the liquidity. And we have the depth, quoted spread, and effective spread. I don't go much detail into the methodology, but we have different stock and day fixed effect and different control variables that I don't go here into the detail. But to see the magnitude of the effect, we find that, as you can see, the one standard deviation increase in the market share of HFT SIs reduces the depth at 14%, increases the quoted spread by 3, and as you see, the effective spread is only 1%. That is much smaller in terms of effect relative to displayed liquidity results. We also do, for each individual MTFs, the analysis that we find similar results, somehow a bit weaker, especially for the kayaks. But we find similar effects for the MTFs as well. And as I mentioned, to see the reasons for this market quality effect, we examine how the trading volume on the HFT SI is related to the liquidity supply of those HFTs on exchanges, using their passive trading as a proxy for the liquidity supply, which is passive volume, the total trading volume by the HFTs through passive trading, and the liquidity supply ratio, which is the fraction of total volume through passive trading. What we find here is that on a stock days that HFTs have trading activity on their own SI platforms. One standard deviation increase in their trading volume reduces their passive volume by 37% on exchanges. And the liquidity supply ratio is reduced by 18%, which is economically significant reduction in the liquidity supply. And we argue that there are two reasons for this liquidity supply reduction. One is related to the inventory management. Basically, HFTs can manage the inventory imbalances that arise as a result of their SI trades by offloading their positions on the exchange, by taking liquidity or quoting aggressively, and instead their liquidity supply will be decreased. The other possible reason is the HFT's willingness to provide liquidity on their own SI platforms, as it can provide them with a low, engage in a less risky transaction by having a lower adverse selection cost. Because they can choose to trade with selected counterparty as well. For this result, we also do it for each individual trading venue, and we can see the percentage of reduction for each venues are very significant, especially for the NASDAQ. There is a 50% decrease in the passive volume, and for the BATS as well, and then also for the KAIs with around 30% in the passive volume, and also for the reduction in the liquidity supply ratio. And the next is about inventories. We use the two measures of inventory, which is inventory crosses zero, which is the number of times an HFT firms change position from long to short and vice versa. And also we have max intraday inventory, which is the maximum absolute intraday inventory as a fraction of total trading volume of that term on that stock day. And doing the similar analysis that we did for the liquidity supply, we find that on a stock days that they have trading activity on the SI platforms, an increase or one standard deviation increase to be exact, in the trading volume on HFT SIs reduces the number of times that HFTs, the corresponding HFTs inventory crosses zero, basically change the position. And here, considering the changing position from long to short and crossing zero as an indication of market making behavior, here we can see, conclude that HFTs engage less in market making on that stock days, what we found in the previous slide as I showed for the liquidity supply. And also it can be interpreted as having SIs can help them to have a better inventory management, so it reduces to the need to offload positions constantly, as they are able to have better control over inventory cost or the penalty cost that it can arise. And when it comes to the max intraday inventory, we find that the larger the volume of HFT SIs are, the max intraday inventory is also lower. I think now I want to talk more about the regulatory relevancy of the papers also as well. Here, as I explained, we find that HFT SIs resulted in a reduction of transparency liquidity on exchanges, higher liquidity fragmentation, or reduction of the supply of liquidity on exchange. And the question would be here is that, does it mean that HFT SIs or in general SIs are harmful to equity markets? Of course, the answer is not really easy. Also, it depends which perspective you are looking at. From perspective of exchanges, they might say yes. Well, I don't know, of course. They might say. But if we look at the overall effect that they had for the market, they have been source of liquidity for the execution of orders. Their existence alongside other venues, in particular exchanges which they operate under completely different market structures, can help various types of traders to find a venue that matches their trading needs. For example, if the trader wants to hide the trading intention or avoid being picked up by predatory traders on the exchange, they can choose a size as they offer lower price impacts and lower selection cost. And also, in general, in terms of fragmentation, they can promote, their presence can promote competition across venues to attract order flow. While we see these benefits that they might have, there are still regulatory issues regarding SIs. That has been, some of them, that has been in the attention of a regulator as well. One is related to pre-trade transparency. As we know that they have the obligation to quote pre-trade transparency, to have pre-trade transparency up to the standard market size. However, what we know as well is that the depth that they are required is only 10% of the standard market size. And as it's seen in the data and the way that they quote, is that almost all of them only quote the depth that they have is 10%, no more. It just maybe a bit more than 10% of the market size, that the way they quote. And also is that looking at the quotes and also the trades that happen at the same time, it's more an indication that maybe not 100%, but most of the quotes are really not, they are more indicative, not the quotes that are really taken into the transaction. The next thing that is related to the payment for order flow that has been very under debate and discussed lately in both Europe and the US. And as you know, this is the practice that the regulators claim that result in not having a genuine competition between liquidity providers, which can result at the end in the lower execution quality for the retail, the retail investors, and all. Even if the execution quality is going, maybe there is a question about the level of price improvement they may provide. And also, when it comes to the HFT SIs and general SIs, according to the European Commission, that they had this proposal released in the last November, they explicitly want that HFT SI being banned from payment for order flow. And they try to attract the order flow by competitive quoting. But I think the issue here is that the focus on the ESMA or the regulator is the traditional way of payment for order flow, which is basically payment, paying cash in return of attracting getting the orders from the brokers. However, for the SIs and also HFTs, without making any payment, they can still get the retail or uninformed order flow that they want. First of, and also at the moment, HFT SI don't make any payment to the brokers. And with this flexibility that they have, they still can do the same without making any payment. So focusing on that can be maybe problematic, just focusing on the traditional way. And the last point is about having the bank SIs as well. They can make an arrangement, an agreement with the broker to route their orders to them in exchange that they have, they cover the trading costs for them, basically clearing or trading fees, which provide a good deal and discount for the broker. And in this way, again, there is no payment being involved, but there is a form of payment order flow that has happened. And I think these two issues are important when it comes to the regulation for the SIs. And if we look at all these three things, that they can capture the orders anyway, which I think the question will be, I close the presentation with one question, always that, is that really the pre-trade transparency regime for SIs is something that is really used actually, or it just, to a large extent, it seems to be symbolic. Maybe it's a bit harsh claim, I don't know, but it seems to be not really being used, and it's a bit symbolic, I guess. Well, that's all. Thank you very much.
Thank you very much, Fatemeh.
You're welcome.
So the discussant is Sachit Sagade from Nasdaq. Sachit is based in Frankfurt, but is all associated with the Stockholm office of Nasdaq. Does it work?
Yeah. Oh, I'm so sorry. Great. Let me start by thanking the organizers, I think, for putting together such a great program, and also for the opportunity to discuss the paper. I think on the left-hand side, at least, this I could have probably just skipped this from my slide. Now I realize, because we already talked about the complexity of the European trading landscape. By and large, at least the way I see it, we have about 8 different types of trading mechanisms that generally compete with each other for order flow. We already talked about how they differ in terms of their transparency, immediacy, and also whether they operate sort of a bilateral trading protocol or a multilateral trading protocol. This paper basically sort of looks at the top left part of this picture, and I must maybe just provide a disclaimer here. I think I have never found 2 people who agree on where each of these boxes should reside on this sort of plane, but mainly because there's just so much heterogeneity even within each particular sort of box here. But so sort of coming to the paper, one of the sort of key factors that has led to the emergence of ELPSIs is the ban on broker crossing networks that was imposed by MiFID II. So on the right-hand side here, you can see the maroon part here, which is basically the BCN order flow before MiFID II was implemented. That basically was completely killed, and we have a periodic auction, ELPSIs, the orange part, sort of becoming a major source of liquidity since 2018. So basically, this coming to the paper, I think Fatemeh did a great job just explaining the institutional arrangement, and I'm just going to really reiterate that here. I think the key part here on how the trading landscape sort of changed since MiFID II was the fact that while the ban on broker crossing networks, one could argue, sort of increased transparency, there are certain exceptions that still exist for how HFT dealers or electronic liquidity providers sort of operate their SI platforms, right? So while they are required to publish two-way quotes, these quotes are not necessarily accessible to all market participants. So in order to actually tap into that liquidity, investors sort of need to connect to a particular SI and then trade with them. And that's where sort of this commercial discretion for the SIs becomes important, that they can sort of, in some ways, choose based on the risk profile of different investors, whether to sort of accept them into their pool or not. And also, they have the ability to, at least in exceptional cases, limit the amount of trading they want to do with a given counterparty. Fatemeh already talked about the pre-trade transparency. While, again, as I mentioned, it increased, there are exceptions or there are different rules in terms of how it is applied for different order sizes, how it is applied for liquid versus illiquid stocks, and so on. And we also talked about briefly about tick sizes, where, the fact that for orders above 10,000 euros, basically ELPSIs can trade at prices which are sort of not compliant with the tick size regime. Now, there's already some evidence that these exceptions are used as a way to engage in what is called as cream skimming, where basically these SIs attract a liquidity which is less toxic, uninformed, whatever you want to call it, and what is left at exchanges then is that much more toxic and more informed trading, which has the potential to harm public liquidity. This paper sort of, I would argue, introduces another channel in how one can view the interplay between ELPSIs and exchange liquidity. So, I mean, the key results here, again, are about how liquidity supply on exchanges by the dealers is reduced. They trade sometimes more aggressively, and overall quoted liquidity on public markets is kind of sort of harmed. One thing that sort of I might add here is that sort of often is overlooked is that the way SIs sort of quote is to a large extent their orders are pegged to the best price, public prices in the market. So you can think of the European best bid and offer, for example. But once you sort of start segmenting liquidity between toxic and non-toxic, there is this tendency for the public market liquidity to widen, spreads to widen, and the SIs themselves are then again benchmarking to the same wider quote. So even if they are providing price improvements, they are sort of providing an improvement vis-a-vis a much wider quote to begin with. So that's something that I think is also kind of an interesting point to highlight. So in a nutshell, I mean, that's kind of the central result of the paper, at least the way I saw it. Coming to some questions, comments, and I'm going to be the first one to admit that these may be something that may not necessarily be incorporated into the paper, but just to kind of contextualize the whole topic. One sort of thought I had was whether it would make sense to observe intraday patterns in how ELPs provide liquidity throughout the day. So the idea here being that they sort of operate with a very strong end of day constraint to end the day flat or by and large flat. So based on that, do you, for example, observe stronger effects towards the end of day? So where the inventory balancing constraints sort of have a priority, or at least get stronger. A related point, which is something that has been recently observed in the US, is whether there is sort of any learning that happens by the ELPs. So one sort of key factor here is that ELPs operate in a bilateral environment, so they sort of know who's trading with them. And potentially that may have that may enable them to sort of get a sense of, you know, where the market is heading, who's buying, who's selling, and whether that is something that is exploited through the course of the day. The second point is, again, something that I've always wondered is how do SIs in general and also ELP SIs choose how to trade, which stocks to trade. So it seems to me that they are not necessarily active to the same extent in all the stocks. So which stocks do they choose? Are there sort of any observable characteristics that you can sort of point to? And also the same question more in a time series dimension, where how do they trade when volatility is high? How do they trade when, or do your results sort of get stronger or weaker here? The last point I wanted to make, and which is sort of very much the elephant in the room almost, is the whole debate about PFOF, best execution, and so on. I was just curious if you could maybe, if you have the ability to observe sort of, who are the clients, or at least some statistics on that, best execution policies, client execution costs, and so on. On this, one sort of point I may add is really about how one thing that is, at least in my view, is missed is the fact that in at least the NASDAQ Nordic market, what we observe is that when retail is trading in our market, we see that they actually earn the spread in more than half of their orders are actually providing liquidity to the market. And we think that this is actually a very important part of how our markets can remain resilient. And that's sort of in the context of PFOF and how retail sort of gets internalized away from the public markets is, I think, something that's worth, I think, keeping in mind, especially considering this is something that is a very European phenomenon. In the US, for example, most retail orders that are internalized by wholesalers are marketable orders, so they almost always cross the spread. Whereas what we observe, what we see, at least in the NASDAQ market, is more than half of retail orders actually earning the spread. So that's something that, that's what, let me finish here. Really nice paper, and yeah, thanks.
Thank you very much, Sachit. Maybe you should go back 2 slides where you had your questions, and we look forward to hear Fatemeh's answers, and then we'll look for questions from the floor.
For the first part, regarding the intraday pattern, it's different between HFT SIs and bank SIs. For the HFT, the trading activity is similar U-shape that we see for the late market, which is a lot during the beginning, opening, and then again a lot, it increases significantly during the end of the day. But for the bank SIs, it's somehow kind of a J-shape. We see it's kind of, it's very in the moderate level, but increases significantly towards the last half an hour of the trading, or maybe 1 hour of trading a day. It's different between these 2 types of SIs. And then about the direction of the, measuring the price impact of the SI trades, we don't see any informative relative what we see for the exchanges. But in general, in terms of extracting information and using on the, for example, for the quoting or activities on the exchange, because when the client or the counterparties approaches SIs, for example, for the searching for the different codes, still the SI can, based on what they request for the code, can know some information about the order that they have. Even if they, at the end, they don't transact with that client, there won't be any trade, they can still have some information without any SI trades happen, and maybe it can be used to for example, quoting. So they use it for the strategies to act on the exchange or other venues. And then, in general, the ALPSIs work more than as trade on the most liquid stocks in general, in terms of. And then, in terms of high volatility, it's relative to exchanges. The exchanges increases a lot in terms of high uncertainty and high volatility, the trading activity, and relative to that, it decreases to them. But this is that we consider only these two venues, not other kind of trading systems. And I think I answered all. Yeah, I guess.
Okay.
And so for the payment for order flow, at the moment, I think we discussed last night, we don't have exactly the client IDs to know exactly, but somehow we try to work on that.
Very good. Do we have any questions from the audience?
Just a reflection, because these are things that we discuss heavily within the Swedish markets, Securities Markets Association. So, and one of the things is the bank SI, which we kind of think banks were forced to become SI in order to continue to serve clients in the way it did before, and face up to the double volume cap. So I mean, we argue that probably that flow would go back to the exchanges if those caps are taken away. So I mean, it's kind of so that then now that is under review, and then you have the HFT SIs, and then the payment for order flow becomes very relevant. And what's important to have in that debate, since it's very limited, as you say, in our market, but the long-term view we have is that if this takes hold, the retail flow that today make up a lot of the lit order books could end up, and in the end have the result that the spreads are wider. I don't think you have seen anything like that, but it would be interesting to see if you see any. Have you seen any more patterns between the HFT SIs and the bank SIs, how they quote and how number of shares they are actually quoting, or because there are two different business models for those two SIs.
Yeah, I don't know exactly in terms of quoting, but as you said, they have very two different business models, and also, but in terms of what we see in terms of trade size and number of trades, of course, it's HFT SIs is still quite the same size, a bit larger than they usually do on exchanges, but bank SIs are the ones that take in the trading larger sizes in terms of trade size, larger volumes in terms of trades. But I don't know exactly about quoting, because I don't have a full, clear access to all the quotes.
No, I know about the reporting problems as well. Thank you.
So the point about an SI that provides free execution being considered payment for order flow is really interesting. Has anyone made a determination on that? It's probably something that I should know at the FCA, but you know, so in the UK, payment for order flow is not allowed. But I guess in the EU they're deliberating that. But in terms of deciding on whether or not that's interpreted as payment for order flows, has that progressed?
So from what I know, there are a lot of different models that are used. I think the sort of the very much US style type of payment for order flow, I think at least in the Nordic market, as I mentioned, is fairly limited. In other regimes, there are like exchanges or regional exchanges where dealers sort of contract with them to provide sort of liquidity in a monopolistic capacity and so on. Fatemeh mentioned about the discounts in clearing and settlement fees, so a lot of PayPFOF sometimes takes that kind of form. But yeah, I mean it's honestly, even I'm not sure what are the different types of regimes, and they very much vary from country to country within Europe.
Yeah, I think that the thing is that the most emphasis of the regulation is now the traditional way of payment for order flow, and it's I don't know, at least I haven't seen any proposal in terms of taking care of different type of payment for order flow that has happened in the European style.
So I have another question if there's still time. So the SI quotes have always puzzled me a bit because I think it's not clear how firm they are. So it's just something that perhaps the industry practitioners can talk to. But so they're required to be there, you know, above this standard market size. But in terms of how the firmness of the quote is it equivalent to an MTF in immediate execution, or is it subject to a bilateral negotiation? And in terms of the bilateral nature, can the SI sort of, do they typically turn off one investor because they've decided they're informed, or do they do it on a trade-by-trade basis?
I can try. I think we're using SIs a lot, and I think that coming back to the payment and for order flow, I think that's a really key. You can talk about SMS up and down, but payment and order flow is a really key question. So just a note on that. But when we trade SIs, we have, I think we're trading 3 SIs. We are connected to a smart router and getting market data from the SIs. And there are a lot of discussions that you have. You need to post your quotes on a home page, and no one looks at that ever. No one looks at this RTS 27 of execution quality. It's rubbish, absolutely rubbish. But I think SI works well. I think because if you compare to pre-MiFID II, you can trade against HFT firms or BCNs or what have you, but you didn't know who you traded against. Could it be an agency or could it be the book? But now, when we trade against an SI, we know that we are trading against the book. So we can take an active decision. So we have different ways of when we route orders. In some cases, we don't route to SIs. In some cases, we do. But I would say that I would say SI works better than I expected, at least, in practice. But no one looks at the home pages on prices. So the smart router gets the price feed and acts on that as any venue with immediacy. It's very hard to distinguish when we technically when you get a trade from CBOE or Virtue. It's pretty much the same.
Thank you very much, Sachit, for your discussion. And I especially like the picture where you showed the BCN volume before, that disappears and then something else emerges. I'm not sure about the causality there, but it seems obvious, at least for the banks, that the internalization that was done in BCN before is done by their own SIs now. So my question would be to Christer, since you have 3 SIs, how much of that is internalization, and which clients do you choose to put on the SIs rather than route to lit exchanges or other venues? And what is the decision that makes you to separate between certain clients? Is it the risk that is low that you internalize and send the other orders away?
I think perhaps some misunderstanding. We get an order and then we route to SIs. So we don't internalize the flow, because we are sending the flow to either to a regulated market, MTF, or an SI, depending on a policy. And we don't distinguish between different type of clients unless the clients instructs us to I don't want to trade in dark pools. I don't want to trade in SIs. But we don't distinguish between clients. So when we get a big institutional order compared to a retail client sending in, I want to buy 100 Ericsson, there's no difference. We don't differentiate between those type of clients. They use the same execution policy, the same algos and everything. And we don't internalize because we can't. Because if you're starting to internalize and do multilateral matching, you need to be regulated as a training venue. So we don't do that. We used to do that 10 years ago, 15 years ago, before MiFID. We tried to match internally a bit before we sent to the exchange. We cannot do that any longer.
Then why is it important to know, why is it important to know who you trade? That's it.
I would say that not important, but I think it's good to know if you're trading against a book or if not. In some cases, there might be risk, not risk, but perceived risk, at least on information leakage. It's a lot of debate about information leakage. When you trade in the dark, we trade with SIs, and you get this effect. You trade on dark pool, and then you see ripple effects everywhere. I think we don't see that so much any longer, but there is always a risk of perceived risk of information leakage. So being able to detect, to identify this is a SI, this is a book, we can, if we need to make decisions when we execute orders, because some clients don't want to trade SIs, some do. So I think that the new granularity in categorization of different venues in the new regime, I think that's very good. I think that's one of the big benefits of MiFID II, actually.
Very good. Thanks to Sachit and to Fatemeh and to all the presenters in this session. Let's give them a hand. And the discussion will now continue over coffee and some more sandwiches. And we reconvene in 20 minutes for the second session.